Joining me on our panel today to discuss what happened in the markets last week as well as what's on deck this week is Louis Cammarosano, who's the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. Like I said, we're going to jump into what happened in the markets last week and the things that are pressing that can affect you and your real estate decisions. Louis, we've got a lot of stuff going on. It seems like one of the leading things in the headlines has been with what's going on in Greece and Italy, and we said that was probably going to be the continuing trend. I did want to lead off with a bit of a different story, though. I was actually reading through some of the local newspapers and whatnot, and one of the interesting stories that I've seen over the last couple months is there's a city, I want to say it's near Detroit, that has opted to turn off its streetlights and rip them out rather than to go further into debt on a $4 million electric bill. With Hyland Park is the city official, is where that actually is. But the residents are outraged, calling the extreme austerity measure a disgrace and accused elected officials of endangering anyone after dark. And the funny thing about the story, not necessarily funny, but they didn't just go to the extent of cutting the streetlights off. They actually ripped them out of the ground. So the people, it's not going to be an easy measure. If you want to turn it back on, you'd have to go and install the light poles back in there again just to get it up and running. Isn't that it's kind of an unusual thing, but it seems like this is kind of a telling trend of what's going on at the local levels on the funding problems that they're having.
Well, that's actually what's happening in Greece. They've told the people in Greece that they're going to have to do without. That's called austerity.
Yep.
And it's strange, though, that the populace votes people in who promise them stuff for free, and then they get annoyed when they can't pay for it and they want to take it away from them.
Right. Yep. And it's just like, you think that, you have to have these things, but if there's not the money to pay for them, you can't afford to do it.
Yeah, but there should be the money to pay for it. If you look at how local municipalities are set up, there really shouldn't be any politics in local government. It should be people pool their money together to get local services, and they hire a general manager to get them the best deal.
Yeah,
they should be able to, pay for fire, police, water, lighting, and so on. But instead, they spend money on other stuff, and then also a lot of the money they have to get from the federal government. It doesn't come from local. So you get taxed by the federal government. You send the money to Washington, and then you elect people locally to try to get it back.
Yeah.
If you just paid locally and you hired a good manager to manage the funds, you should be able to run a surplus.
Yeah, and
everyone is running on the concept that you can get money from Washington, you can get money from a bond issue, you can get money from somewhere until you can't get the money anymore.
Right, and but this seems like this is going to be something that's going to be taking place across the country. I mean, they're saying that the money's not there, and they're ultimately electing to get rid of certain things, which I would think are more of necessities than anything else. I mean, you get rid of streetlights, and all of a sudden your crime rate shoots through the roof. Oh,
sure, you get rid of police officers; it's the same thing. But if you also look, that's what government generally does. Is they don't say they're going to get rid of the legislature's per diem. They're going to get rid of the legislature's whatever the things are that you don't need, they never say we're going to cut those. They say they're going to cut the most essential services to get you to pay more.
Right. Yep. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by my guest, Louis Cammarosano, the general manager of HomeGain. Another interesting thing over the weekend, I believe it was actually November the 1st, but remember how Bank of America had instituted that they were going to charge a $5 a month debit card fee?
Yes.
That has actually
backpedaled on that.
They've now backpedaled and stepped back on that. They're no longer going to charge for that. Announced basically saying that it's canceling its $5 debit card fee in response to customer feedback. Customer feedback, would mean to me that people are closing accounts, which I think this is a great example of just letting the free market be, and things will work themselves out.
If there are enough alternatives where people can put their money, but when there's generally only 4 big banks, then people, and if they all move in an oligopolistic fashion, meaning an oligopoly, if one does it, they all do it. But in this case, they didn't all do it. Then the consumer doesn't have a choice. If there's 4 banks and they all institute the fees. But I guess they're going to credit unions, isn't that right? Yeah,
and actually I was going to bring that up. There was actually something that was set for November the 5th, which was called Bank Transfer Day. Kristen Christian, who is an art gallery owner in Los Angeles, California, was dissatisfied with Bank of America's ridiculous fees and poor customer service. She created an event on Facebook called Bank Transfer Day and invited her friends to close their accounts at big for-profit banks and move their money to credit unions on the date of November 5th. And I mean, in a matter of time, like want to say less than half of a month, she had over 50,000 people on there. And they said it was a pretty substantial amount of people that actually took their money out of the bigger banks and are putting money into credit unions, which it's interesting because these credit unions are really, they're really playing to the general public right now. I mean, it's a great marketing thing for them that the big banks want to charge these fees because they're just, basically taking up all these other customers. And, Bank of America is not the only one that had this fee. Believe it or not, I'm pretty sure that SunTrust was the one that started this. And they kind of flew under the radar. And then it was Bank of America, then it was Wells Fargo. So there was numerous banks, and I'm pretty sure all of them are going to be backpedaling and taking the stance that they can't charge this fee because people would just move on to another bank.
Well, what's interesting is how much money can they really make from those fees?
Well, they said it was a ridiculous amount of money. I think that they were banking on some $500 to $600 million with all the major banks going to some model like that. Because
I guess it's money that doesn't cost them anything, but none of their practices cost them anything.
Right, and that was the whole reason that this fee even came about was because there was a Durbin Amendment that went into effect on October 1st, which was in addition to the Dodd-Frank Wall Street Reform bill that basically said that it was limiting the fees that the bank could charge merchants when a consumer was swiping their debit card from 44 cents to 24 cents. So they were saying,
so they turned around and said, "Well, we'll make the consumer pay for it."
Yep, let's pass it on to the consumer. That seems like it's the all too easy thing to do. When in doubt, just charge the consumer. But at least there has been some backlash on this, and I'm kind of glad that this has happened because it's, if you get enough people to do this or to cancel their accounts or close them out, then you're going to see that banks are going to take measures to try to get those customers back.
Sure. What you just highlighted, though, is the unintended consequence of a government action where they thought they were actually going to get rid of those big bad fees by limiting them. And then what the bank does is they turn around and they try to charge the consumer. And then what the free market does is says, you're not going to charge me for that because I'm not going to pay for it. I'm going somewhere else.
Right.
So basically, when you think about it, the government intervention was a big waste of time where basically now we're back to where they were in the first place. They're going to, if they don't have to charge the fee, the customers will stay with the bank.
Yep. Yeah, it's absolutely.
Create a lot of useless economic activity and Facebook activity and people talking about it when really nothing was produced in that whole rigmarole except trying to get out of a regulation.
Yeah, exactly. Yep. I mean, it does seem like a lot of wasted time for nothing. We're going to jump into some stuff today, Louis, on one of them is I've had a lot of emails and calls from clients on, what's the best way to go about shopping for a mortgage and what can people do to ensure that they're getting the very best rate possible. And we're going to give the listeners the top tips to, shopping and obtaining a home mortgage. And also we're going to jump into why home appraisals are actually derailing or killing a lot of home sale transactions and what you can do to prevent your home that you're trying to sell from falling into that category. But before we do that, we're going to jump into what happened last week in our Word on Wealth. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to homegain.com today to see what I'm talking about. All you have to do is type in your home address, and you'll get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's completely free. So check it out today at homegain.com. This week, as far as things that are going to affect interest rates, obviously, we always want to have a pulse on the market and figure out from day to day what's going to happen and what's going to make mortgage interest rates rise or fall. And this week, we don't have that much economic data on tap, but the Treasury will sell $72 billion in note and bonds in its quarterly refunding on Tuesday through Thursday. The mess in Europe is going to continue to dominate the U.S. markets. Over the weekend, Greece politicians agreed to form a new government with Papandreou stepping down. A new government probably won't change much, though. Greeks will still be required to accept very serious cuts in spending that will impact more jobs and higher taxes in order to get more money from the European Union, the IMF, and the ECB. And like I said, this contagion has now spread into Italy, where I believe that it seems like they're completely unraveling right there. And in essence, somebody's going to have to take some cuts. There's going to have to be deep cuts, and I don't think that they're willing to do that. I'm actually surprised, Louis, that things are actually lingering on as long as they have. And I'm curious to get your take on what you think is going to happen over the next couple of weeks with that.
Well, I think they're lingering on because the central banks have been propping up the Greek bonds. But eventually, if you think about what you mentioned earlier with the municipalities in the United States, now, if we get more and more municipalities that start to run through these austerity situations where they cannot properly pay for police, fire, lighting, and so on, they'll probably get a bailout from the federal government. And I know they said they haven't done it, but that's a case where they step in. Now, if that happens, that can have an adverse impact on interest rates because you're going to create massive inflation if they have to print up money, not just to help Greece in conjunction with the European banks, so the Fed has to help that, but it has to help Italy and has to help all the municipalities who can print up money. It just seems to me that there's going to be a lot more opportunities for the central banks to print up a lot more money to either help out or make a situation better. Somewhere across the globe, there's in Western Europe and the United States, there's a need for money that isn't there. And the only way they're going to get it is by printing it up.
Yes. Yeah. I absolutely agree with you there. And, like we always talk about, the printing of money is just going to be a temporary solution for different countries. And really long term, it's not going to fix anything.
Now, the difference is the United States will probably outlast the euro. The United States probably has the ability to debase the currency and print as much as it wants a lot longer and a lot more than any other country. But at some point, the United States can't do it either.
Right.
I mean, what's going to happen in Europe is they'll try to bail out Greece. They'll try to get the U.S. to help. They'll even try to get Japan and China to help. But you just can't keep bailing out. You have to let the sovereign default.
Yeah. You have to let entities fail.
And that's true in the private sector, and it's true in the public sector. If a country or a company gets overextended and owes money, they have to go through the bankruptcy process.
Yep.
And that's a very good process. It allows you to liquidate the debt and start over.
Yeah, and I think, every day we're seeing more and more of these smaller banks actually, basically going under. FDIC is having to come out of their pocket and pay for the difference of what's not there, but yet we'll allow these smaller banks to fail and or to create other mergers and acquisitions there. But the big banks were not willing to take the same approach.
Right, and the FDIC in itself is flawed because that already owes money, and they just print up the money, or they work to try to merge it to the banks. But that creates a moral hazard because if all the banks are insured by the FDIC, the depositors in the free market don't examine their bank and worry or wonder how creditworthy their money is or how safe their money is. They think, oh, it's FDIC, so they put it in there and they don't care. And then the bank knows that they're insured, and they go and do foolish things with your money.
Right. Yeah.
Knowing that they're either going to get bailed out or they're going to be able to tap the FDIC.
Yeah, it's actually incredible to think about that whole system and how it works. I mean, like I said, I think year to date we've had close to another 80 banks that have gone under, most of which people don't even know this is going on. But every day, it seems like there's a different bank that's going under. And the system, we have to let these banks fail.
Well, most people, Ryan, don't understand the concept of fractional reserve banking, that when you put money in the bank, they don't have your money. They then go ahead and create money based on your deposits on a 10-to-1 ratio that they can now loan more money out.
Yep, they're leveraging it 10-to-1. Yeah,
that's why you have runs on the bank. You can't have a run on something if you have a ticket for it. If you put your chair in a warehouse, they give you a ticket. They don't say your chair's not here anymore.
Right.
They get arrested for fraud, but the bank can do it all day.
Yeah, it is pretty amazing that goes on, and I think that that's part of the system that probably needs to change. They shouldn't be able to leverage that at a 10-to-1 ratio. It just doesn't even make sense to me. When we come back, we're actually going to jump into why Freddie Mac has asked for another $6 billion worth of funding. You're listening to Real Estate Radio. Be right back.